All right, we're back for another Friday Financial Wrap-Up with Mr. Michael Zuber. How are you, Michael?
I'm doing very well, man. Every day is Saturday.
Every day is Saturday. Well, today is Friday. So for you, it's Saturday. I love it. I got stuff to do. Let's get into it. May the 30th, 2025. Where did the month go? Isn't it crazy?
Yeah, 5 months of the year down. How are people doing on their goals? What's going on? It's getting really, these years are going by faster and faster.
Time is flying. Let's get into the show. Uncertainty returns. We had uncertainty. We thought we were through it. We thought, okay, now we're stable. What happened this week? What's your take on uncertainty this week?
Not only did I think we were stable, dude, I thought we were improving day after day, right? This was like my call of July 20th, the 6-month mark was looking like a layup. And then, out of nowhere, this, International Board of, Judges of Trade or whatever the heck they're called, come out in rules that Trump's tariffs are unconstitutional. Shortly later that evening, I guess, gets a stay by appeal, likely going to the Supreme Court. Now we have talk in the administration. If this doesn't work, they'll try something else. Then we have President Trump coming out and basically saying China is cheating again. And then on top of that, this is both hilarious and actually sad. Yeah. There was a press conference, I think, on Wednesday where a reporter asked President Trump about the taco trade. And if you don't know what the taco trade stands for, it stands for Trump always gives up, basically. I forget what the actual acronym was, but always chickens out. Even worse, Trump always chickens out. And let's just say President Trump didn't like that. I don't think anybody is surprised that this man's history is not going to like that. Probably takes it as an insult. But why is it important? It's kind of like Fight Club, right? What's the first rule of Fight Club? Never talk about Fight Club.
Right.
That is such an idiotic move, because now, there was a relatively big trade, I guess, by Wall Street, basically knowing that Trump's going to back down. Trump looks at it as negotiations, no doubt. But now he's like, all right, you mother effers, you want to play this game? I'll show you. And It's like, guys, why are you poking the bear? Why are you ramping up uncertainty? We were in such a good place. And dude, I'm looking for some nuke. I don't know if this China threat is his way of, effing the taco trade, but he was clearly not happy when that was brought up. And I expect him to show his displeasure. And again, dude, we were on such a good path. We weren't out of it. It was still dark, but we could see the light. And after Wednesday and then Thursday and now Friday, I mean, every day is getting worse and worse. So yeah, I'm afraid that uncertainty is back, and I'm actually a little bit nervous about the weekend. Right, yeah. The markets are closed. Yeah. Trump knows that the markets are closed. Does he come out with some haymaker over the weekend and surprise us? I don't know. I just feel like we were so close to having all this positive momentum, and it's gone. It's just freaking gone. So not good.
Not good. Very eye-opening. Something obviously we're going to keep our eye on. Not in our show notes, but I want to just say too, I'm going to circle back for all the viewers, listeners. I'm going to come back to the bond market, what happened this week. It's not necessarily in our show notes, but talk about in terms of how the bond market reacted. Yep. And how it's going to affect rates and what we can expect. So we're going to talk about that at the very end. Stay to the end. Let's talk about PCE. What is it? What happened?
Yeah. So again, every month, folks, we talk about 3 inflation readings. 2 of them come out early. 1 of them comes out late. And PCE is the third. The first 2 are CPI and PPI. PCE is important because the Fed has told us repeatedly it's their favorite measure of inflation. And, inflation looks great. The headline inflation, guys, came down to 2.1. That's really, really close to 2%.
Right.
And
explain
then core,
the 2%, why that's important. The 2% real quick.
Yeah, Jerome Pal, all the Fed officials have been saying they're basically fighting inflation. They're going to get to 2%. They're going to get to 2%. Well, you know what? 2.1 is just about as close as you can get.
Yep.
And then they could declare victory. And then in theory, if they wanted, they could start cutting rates because they've won the battle. More on that in a minute. And then headlines 2.1. But in fairness, the Fed has always said PCE core is their favorite metric, just to put a fine point on that. And it too came in better than expected. It came in at 2.5 instead of 2.6. So again, clearly heading in the right direction. Clearly, the print was better than expected. However, as I've said all year, because inflation is one of these things that you could look out and calculate roughly, we have 3 bad months. The next 3 months will very likely show inflation increasing. And the Fed knows this. The Fed absolutely knows this. This is something called the base effect. We basically had 2 flat months and I think 1 negative month last year. So even if PCE or CPI goes up month on month, like 0.1 or 0.2, which historically is a good number, it's going to look like inflation is increasing again. So there's 3 months. We have to get through these 3 months without inflation exploding higher. And then the rest of the year is really good. There's when you look out at the base effect and what numbers are rolling off, there's a very good chance we're at or below 2% by the end of the year, but not these next 3 months.
Well, here we go. So we think inflation's fixed. The base effect, which I think I've heard you say it before. Again, something new. Let's keep going in the show. Trust me, everybody, we're going to, at the very end, I'm going to pepper Michael about what does this all mean, right? How does it affect investors? How does it affect the mortgage market? Let's keep going though. Personal savings. What happened?
This is an important one because again, we are an economy driven by consumers. I have been telling you repeatedly that I think the consumer after Liberation Day sat on their wallets, and the hard data is just now coming out. I think this is one of the biggest examples that I was right. Personal savings rate last month and pretty much all year was below 1%, right? Specifically last month, it was 0.6. Guess what happened this month? The consumer is scared. When the consumer is scared, what do? They save. So out of nowhere, consumers' personal savings jumped to 4.9%.
Wow.
That's a monster move for a single month and just shows you how scared the consumer is. And again, we got it right. We've made lots of calls on that. And it's all to be expected. Yep. Consumers
are slowing. Consumers are saving. At least they're saving. That's a good thing.
No, it's absolutely. Absolutely.
So let's talk about, you've got something special. I had so much fun. The audience was great. We had a great time at school. Sunday, you're doing a special school. Talk about it.
Yeah, last week you were gracious enough to come on and give us 90 minutes. Historically, my sessions have been 1 hour. But I actually have a 2-hour block open this Sunday. So we're going to go from 8 to 10 a.m. inside school. We're going to make sure you get to all of your questions. And more importantly, it's going to be the 3 amigos. Dion and Matt the Lumberjack have all agreed to participate. So we're going to have the 3 amigos live 8 to 10 a.m. We'll answer any and all questions. And I look forward to going for 2 hours inside school this Sunday. So if you're not a part of school, sign up, give it a test run. It's $20. Our time, the 3 amigos time, is certainly worth more than $20 for 2 hours. I mean, geez, can you believe that? Not to mention everything else. So I look forward to a full house this Sunday. I look forward to a lot of people signing up, hopefully today, tomorrow, so they can just give us a test run. If you don't like it, cancel, no big deal. It's not a year-long commitment. It's only month to month. But yeah, we're going to go for 2 hours this Sunday, and it's really thanks to you, Ty. You showed us that we could go for 90 minutes. So I said, hey, if 2 of us can go for 90 minutes, how long can 3 of us go for 2 hours? So we're going to give it a shot.
That's strong, man. I got to say, I pay hundreds of dollars to be in masterminds or to be in coaching programs where I can get on a Zoom and ask a few questions from the expert, the person that's the, subject matter expert, for $20 a month, folks. It's pennies, 67 cents a day. Get involved with school. If you like these videos, if you're a follower of the One Rental at a Time channel, get yourself into school, take it for a test drive, try it for a month, come to some Sunday sessions, check it out. Michael, thank you. That's awesome, man. Let's keep going. Fed minutes. What happened this week?
Again, every 6 weeks after a Fed meeting, we get what's called the Fed minutes, which is basically a summary level of what the Fed talked about. Most months are a yawn, a bore. And frankly, some months are so boring, I don't even look at them. But this month was important because we had to figure out where the Fed's head was at, right? Because again, the Fed meeting occurred right after Liberation Day, where lots of assumptions were being made. There were no pauses or anything as of yet. So we had to figure out where the Fed's head was at. And the Fed, if we were just to summarize it to one point, is concerned about stagflation.
Yep.
That is wild for me to think about because that's the worst case scenario. The Fed can't fight stagflation, at least fight it easily. They have to pick a war. They can't fight on two fronts. They either fight a weak job market or they fight prices. And the Fed meeting minutes all over the place was, I think they actually said stagflation once, but they talked higher prices, weaker job market like dozens of times, which is, aka stagflation. So I think that was pretty important. Let's take a comment from the audience. It's actually watching live. We got Angel here. Let's put it on the screen.
Angel, what's up, buddy? This is not just a fan of the show. This guy is a doer. Angel takes massive action. He listens every week to you. He listens to the daily news. This guy is about it. Please go ahead and do the question, Michael. Sorry, I
appreciate it. No, it's all right. No, I love it. I love the fact that we know lots of the same people. Angel asks, how many cuts, Mike, by the end of the year? And Angel, at this point, I haven't changed my opinion. I rolled into the year, frankly, I think as of November 2024, I said 0 cuts in 2025. I see no reason to change that at this point. I do think part of the reason I'm still stuck on 0 is I think the Fed is going to be late. I think the Fed is very afraid of repeating Arthur Burns, which is a gentleman, a Fed chair who let inflation come back in 81. I also think Jerome Pal knows that he's going to be out of office, I think, in May of next year. So he's like, he's got like short-termitis. He's just basically flipping the middle finger to President Trump. He's like, I don't need to listen to you. My job is safe. And, if we were going to get one, maybe December, I reserve the right to change my opinion because we're going to go through some stuff later on the show that are could be a problem. But as of right now, 7:44 a.m. May 30th, I'm still stuck on 0. So thanks for your question, Angel.
I love it. You got to have Angel on the show. He takes action. He just did a flip. The tide turned on him, this whole wildness over the last 5 months. He definitely, let's get Angel. Angel, we're going to get you and Michael connected to have you come on the show. I'll set it up. I'll interview. I'll email you guys after the show today. Let's keep going. Let's talk about consumer confidence. Obviously, we talked about savings.
Yep.
Tie it all together. How does consumer confidence tie in?
So consumer confidence was really important because we rolled into Liberation Day right after at nearly a low. It was the second worst reading on record, which I think was 86, I think.
Wow.
And it wasn't expected to get much better. But I kept telling everybody, uncertainty's getting better. Uncertainty's getting better. Uncertainty's getting better. And boom, consumer confidence jumped to 98. Now it's still, it's not warm and fuzzy time. You got to get over 100. But a 12-point move in a single month, it moved across all ages, all political affiliations, all income levels. Everybody felt a little bit better. And I was like, yep, uncertainty is going away little by little by little. And if that had continued, you're going to start to see people make investments. They're going to start making purchase decisions. But of course, as we started the show, I think we took a big step backwards late this week. But again, consumer confidence this week was a monster, 98, where it was 86 last. That's just a massive move.
Very, again, something, thank you that you keep your eye on it, something that we're going to pay attention to. Let's keep moving and let's talk about weekly jobless claims. And then also, just in a short snippet, explain what the dual mandate is of the Fed and why I think it ties to Angel's question, Why is the Fed not going to cut? Talk about jobless claims this week, and then kind of maybe pull that together.
Yeah, so we'll start with the dual mandate. I think that's where you go. So the dual mandate is simply said, stable prices, full employment, right? So a strong job market and prices that are stable. That's what the Fed wants. And the Fed, generally speaking, accepts 2% as stable. Anything above 2% is not stable. So PCE headline 2.1, pretty close to stable. But again, as we warned, the next 3 months could show. I mean, I don't think I said this earlier. Like in 3 months, PCE headline could be 2.4 or 2.5, just mathematically speaking. And again, that's not because the next 3 months are going to be horribly inflationary. It's just that they weren't last year.
Right.
And when you roll the base effect, it doesn't take much to move that higher. So again, the Fed sees that. To Angel's question, that's why the Fed's not cutting today. Because if the Fed cut today and then the next 3 months inflation is up, they would look like a fool. And they're not game for that. Jobless claims. Oh, the dual mandate. So full employment. This is the one. This is the thing that could cause a rate cut it could cause a rate cut quickly and could cause a big rate cut. What's a big rate cut? Normally the Fed moves in quarters. If this breaks, they could cut a half, which tells you the Fed is afraid. So weekly claims for really pretty much the last year have been bouncing around 220 to 230. We've had a couple of weeks where it spiked up. We got concerned, but it spiked right back down. Well, we've now had 3 or 4 weeks of weekly claims going up. It just posted 240. And, anything above 230, I get nervous. This is the third week, I think, above 240. But more important, as I've said all year, I think this crisis is going to be different. It's not going to be the unemployment rate. It's not even going to be the weekly claims. It's going to be continuing claims. And continuing claims just put in a cycle high at 1.91, I think, which means duration is getting harder, right? If you get laid off, it is harder to find a job. That is what continuing claims show. And that is my big fear for the rest of the year, right? There's a chance that unemployment rate, I think it's 4.2 today. It doesn't get much above 5, but continuing claims, it could hit 3 million, right? Which is a 50% jump from where we are. That's just because companies are not opening recs, not hiring. They're holding on to what they have. But that's the big thing, continuing claims. So if that breaks, if that shoot higher, historically speaking, unemployment takes the elevator up and the stairs down. So, every week, every Thursday, we're going to be paying attention. And this week was, a yellow flag.
So a yellow flag this week. And then again, something I feel like we were heavily focused on this show. We were heavily focused on jobs. That again, this is the whole thing that's going to this is what's going to move the Fed. This is what's going to get the rate cut. No other headline is going to really move the Fed.
No, I think so. I mean, just for example, to put some numbers on this, if we stayed below 250,000 every week for the rest of the year, I'm not saying we will. I'm just going, what if? I don't think the Fed cuts. They're not concerned with 250. They're concerned with 350, 450, but not 250.
If we go back and look at like 2007, 2008, what were the claims like? Just
well over 300, and some weeks were over 400,
and consistently for months and months and months.
Take the elevator up, just. Yeah,
that's the elevator up. Okay, that makes sense for the listener, the viewer. Makes a lot of sense for me. Let's keep going. Pending home sales. I'm going to pull it all together at the end. I'm going to pepper you with questions, Michael.
I like it.
So, pending home sales. What happened this week? What's your take?
Again, I kept telling people what's going to happen. It's going to be the worst year of the cycle. Below 4 million. It's just rolling out that way. Pending home sales were down 6.3%. Last month they were up 5.5%. They were down 6.3%. They were expected to only be down 1%. So, I mean, if you're watching this channel, you're in the housing industry. It's slow out there. That the spring selling season was a dud. That inventory is building up. Rates are higher, and something not in the show notes, but we might as well throw it in here. I'm actually concerned that if Fannie and Freddie get spun out and are private, right, they're no longer under conservatorship. Yep. You guys got to be ready for an 8% mortgage rate. I mean, think about that. You think it's bad at 7%. You spin Fannie and Freddie out, suddenly mortgage rates are 8%. Woo! That won't be any fun.
You think a privately held Fannie Freddie, if they spin it off like Trump's talking about sending that public to the public markets,
Yep.
you think that the margin goes to so that would be like a 3.
Yeah, it goes to
3.5% margin.
I don't know how it doesn't. I mean, when you break it down very simply, today we have an explicit guarantee. Yeah. That's what conservatorship is. The government stands behind. If you're going to go from an explicit guarantee to an implicit guarantee, I don't know how it's not wider. Okay. An implicit guarantee is clearly not as good as an explicit guarantee.
More risk for investors, basically. Thus, has to have higher margin, higher return.
Not only that, but don't forget, if they're privately held, they're going to be a lot more picky. They're going to do a lot less loans. They're going to stop taking the risky players. So not only will rates be higher, but I bet they do less loans. Think about that.
Yeah, makes a lot of sense. Makes a lot of sense. So let's pull it all together. Okay, I'm talking with a couple of good friends this week. They're saying, hey, Trump had a private meeting with Jerome Pal, and Trump's going to get him straightened out.
No chance. Jerome Pal is on a clock. His term ends in April or May. And, he won't do it publicly, but I guarantee you he's flipping Trump off. It's like, I don't have to listen to you. Not
pure independence. He
knows if he gets fired, the bond market flips out. He's got the bond vigilantes behind him. Right. If Trump pulls out, the gun and shoots him and says, hey, you're gone because I said so, the bond market's going to lose its shit.
Okay.
So yeah, Trump, Powell's like, you can't touch me. Powell's Teflon right now. He can't be touched.
Very interesting. So let's talk about let's go back to the bond. Like, okay, they signed that bill. The bond market, right, at one point, rates, peaked over 7%. We had a big jump. They kind of leveled off a little bit. What was that all about? Explain how that worked in the bond market and why they reacted that way to that new bill and the way that those new things that just got signed in.
Yeah, so I'm going to reference them as the bond vigilantes. And a lot of you may not know this, but the bond market is like 3 or 4 times bigger than the stock market. It's massive. And the bond market is already forced the administration to change stance twice. So again, if you guys don't remember, Liberation Day comes out with these, trade, deficits, which he calls, tariffs, which is just whatever. It's not right. But the bond market sends rates higher immediately.
Yep.
And it gets so bad that Scott Bessent has to go to Trump and say, basically, you got to create a 90-day pause. And Trump does. Bond market comes back. Then Trump goes nuclear on China. Bond market doesn't like that. Rates go higher. Trump issues a China pause. Now, just recently, I think it was late last week, over the weekend into this week, the House passes Trump's big, beautiful bill, which at high level is estimated to add somewhere between 3 on the low end and $8 trillion to the national debt. Clearly not what, we were promised in, cutting and this, that, the other. And the bond market loses its mind again. So what is happening? Why did the bond market recover a little bit? I think because folks like Ron Johnson in the Senate basically came out and said, this is a non-starter. We're not going to pick this up. We're not going to approve this. I believe the bond market believes Ron Johnson, that believes this bill is basically dead and buried as it is written. It's got to be dramatically changed. We can't keep exploding the national debt. That leads to a very bad outcome. And the bond market responded, and I think it calmed down because the Senate said, we're not picking this up. It's no good. So I think that's what happened.
Okay. Very eye-opening the way the bond market reacts. Obviously, we need stability for stable rates. Let me go back to something, again, to your prediction. You said the year will average 7%.
I did.
I feel like we were trending down, right? I don't know that did we touch 6.5 this?
Yeah, I think we did. I think we hit 6.5 for a brief 2-day period. Yeah.
Okay. But overall, I mean, I'm looking at the chart. I'm just looking at the line of the EKG of the 30-year mortgage, and it looks like we are averaging.
Yeah, we're really close.
7%, right? Do you feel like that's on point right now?
Yeah, I mean, I feel bad because I think it was a month ago we were at 6.5, and on this show I said, you know what, I think I have to give up on that one. I think I might have got that one wrong, but I gave up just a little bit too early.
I don't think you gave up because in my mind I'm like, damn, Michael's right. Look at that thing shoot up back up to 7, and it's sticky. It's sticky at that 7 range.
Yeah.
What do you see going forward? How do you see, like, what's going to happen next?
Again,
what does Michael see? What do you? We're not going to hold you to this. We don't have to get a T-shirt.
No, I see no reason why this year is going to be any different than what I thought coming to it. It's going to be the last hard year. It's going to be a lot of uncertainty, a lot of fear. We just got to get to a better place. And as we started the show, I thought we were getting better with uncertainty, but it came back and smacked us hard on Thursday or Wednesday, whenever that was. And all of that said, it's just going to keep people saving, keep people not buying homes, not buying cars, not doing trips. Their savings rate's going to go up. But that's going to all be kindling for next year. 2026 will be better than 2025. The average consumer, in my experience, can be afraid for about 6 months. And then after 6 months, when nothing happens, they're like, okay, I'm good. We're okay. And they start loosening the purse strings. But dude, we are in it right now. It is ugly out there.
It definitely feels ugly. Let me, do you have a hard out at 8?
Nope, I'm good.
Okay, so we can riff. So let's talk about a couple things that came to mind for me also to kind of bring this together for the show. You talk about disrespectful offers. I would describe them as aggressive offers because, again, I represent a lot of sellers, and, you know, disrespectful offer,
yeah, I understand.
Aggressive offer, I appreciate. So I'm representing a client. The property's, let's just call it somewhere around 600,000. Mm-hmm. We initially get an offer at, like, let's call it 5.5. And then all of a sudden they're doing some diligence and they come back at 400.
Oh, 4. Woo.
Yeah, that's disrespectful. Of course, the seller is financially very, very secure. We tell them, go pound sand. You know, you need to you need to figure out how real estate works. That whole thing, it would have been better to even come in low and then work your way back up. But anyway, okay. Let's go to another one. I'm doing a BPO.
Well, hold on. Let's finish this one out. Let's pretend that's me on the other end, the guy that offered 400.
Yeah, please go ahead.
So I love, because again, I can riff on this one. Yeah. So again, first and foremost, a 550 offer. How long was the property listed before the offer came?
A couple of weeks. Only not even a week and a half. At that moment.
So if it was a week and a half of 550, makes sense to me. Now let's just pretend for a moment it was 90 days. Yeah. Because that's where I start to play, is at 90 days.
I got a good one there too.
Yeah. So I would never offer 550 on a 600K home if it's been listed 90 days. I would have been around 475, maybe 499, 487, something like that to start with. Then let's say we get into contract at 515. We're just playing a game together, right?
Right.
At which point I start spending some money. I do some inspections, and let's assume there's some real issues. The roof is gone, you know, whatever. And let's say the repairs are 40 grand. In a market like we're in today, I'm getting that seller to agree to at least 75% of that 40, or doing all the work themselves if they think they could get it done cheaper. That's just where we're at. This is a buyer's market. So, you know, that's the game I'm playing.
I'm going to get the seller full price, bro. Come on.
I know you are. I know. That's just how you roll.
There we go. So, no, but it's a great property. It's a one of one. It's got a bunch of unique features. Time will tell. I'll come back to it. But this was interesting. I'm doing a broker price opinion. Mm-hmm. This is for a foreclosure property.
Okay.
Now, this was probably the most eye-opening thing. Like, this is a beautiful $1 million gated golf course community. In that particular region, it's probably the top 3 or 4 best neighborhoods in that county. Okay. So this place is a nice place to live. A bunch of city council people live there. You know, like, it's a great neighborhood. $1 million neighborhood.
Okay.
I'm seeing comps at go back to the beginning of the year. Everything's 950, $1 million, $1.1 million in this particular area. I almost fell out of my chair. I saw something that came on in the market just under $1 million, like call it 990.
Okay.
It was on the market for 113 days, 116 days, something like that. Sold for $770.
I love that person, whoever bought that. That's what I'm talking about.
And not only that, but then I started seeing a pattern of 900s closed in the sevens, different ranges in the sevens, different houses and so forth. But so you see like a $250,000 swing.
Yeah, this is coming, man. And again, here's the deal. I mean, people need to pay attention. That house in that neighborhood is clearly above the median, right?
Yep.
For the area.
Very much above the median. Yep.
And that's where the pain is. If you happen to be lucky enough to shop for a luxury home today, if you're not getting a 20% discount, you're not trying. In a lot of markets, the luxury area, if you just slice out the luxury, you're averaging over 100 days. In Orange County, our boy Adrian, the $2.5 million and above, 300 days.
Yeah.
Dude, that's where the pain is. It's in the luxury. The entry-level, clean, move-in ready, first-time home buyer, it's still a unicorn. It's still rainbows. But, the luxury, it doesn't shock me. We're going to see some people that just have to sell. They want to sell, like they're done, right? They lived here, they raised their family, they want to go to Texas or Florida or wherever it is. The extra $100,000, sure, they like it, but it doesn't. They own it free and clear. It doesn't matter. They want to be out.
Also, another interesting thing, and we talked about this on Sunday in the school community, where I talked about too a seasoned owner, somebody who's owned for a really long time. And it's interesting when I looked at that 990, 770, that spread. It's a property that the people bought it in the early 90s. They bought it for a third of what they were selling it for. You follow me?
Yeah, they bought it for 2 goats and a cow. Yeah, I got you.
Yeah, exactly. So they were still winning. It wasn't they were still winning. It wasn't, but again, a great deal. Talk about too, so if you look forward, what we've seen over the last 90 days, what we've seen over the last 5 months, probably more of the same between now and the end of the year.
Dude, I actually think it gets a little bit slower because we're leaving the spring selling season.
Yeah.
Dude, it's behind us. And the big question I have right now, and I don't know the answer, but I have a sneaky suspicion that the fall market, so let's call it September, October, is going to be much better than historical. Because if I'm right, and we get all this nonsense and uncertainty behind us, and we start to get a little oomph in our system, and I think we're going to have a lot of these people that were sitting on the sidelines go shopping in September, October. So I don't know if that's right yet. It's kind of a spidey sense, a gut feeling right now. I'll wait a few more months till I kind of make that call. But I got to tell you right now, and what will happen is that will just lead into a much better spring next year.
Got it. Yep.
But yeah, I'm on record. 2025 is going to suck. It's going to suck for a lot of people. It's going to be the last hard year. And, we get, and again, 2026, when you compare to 2025, is going to be better. It's not going to be 2021. It's just going to be better than 2025. I need people to hear that. Some people hear me say that 2026 is going to be better, and they're like, what are you smoking? I'm like, hey, asshole, I'm just comparing it to 25. I'm not comparing it to 21. So
right. Yeah. 21 or, 2006 or right.
Yeah.
Which would be the peak. Was this the slowest April since 2009? I was talking with a buddy. He said that was a stat. Is that accurate?
Yeah, absolutely. Existing home sales non-seasonally adjusted was the second worst April since 2009 or since 2000. And that came from Resi Club Analytics, Lance Lambert. It was just bad. And again, I'm feeling really good about my less than 4 million call.
We're going. Yeah, I'm with you. It feels sub 4 million. The reason why I have confidence in the $600,000 that property, he is a viewer and a fan, somebody I met through the One Rental at a Time community. But also too, it's around the median. It's around the median under median minus. So it's a different market. It's not luxury.
No. If you're at the median minus and you're a 1 of 1, you're going to get your price. That's just how you're going to get it. You're going to at least get really close.
Hey, and I'll fight for him, right? You know that. I fight for my clients, right? See the stitches?
Yeah, you do. Yeah, exactly. That's what happens when you receive a disrespectful offer. You fight back.
I fight back, folks. Thank you for watching Friday Financial Wrap Up. I only have one call to action. Normally I'd say subscribe, comment, whatever. No. Today, put $20 and invest in yourself. It's the weekend. You're going to spend $20 having fast food, coffee, something this weekend. You're going to blow $20 like it was nothing. Pull out your credit card, go to the school community, go sign up for the One Rental at a Time school community. Get yourself on that Sunday 2-hour Zoom with Michael, the three amigos. Michael, thank you for all that you do. Have a great weekend, brother.
Later, man. Take care. Thanks again.